What is the best mortgage? If you're planning on buying a home, then that question is probably heavy on your mind. And unless you're planning to pay cash for the house, it's a very important question because it's going to influence several aspects of your home purchase. In this video, we're going to take a look at a few of the factors that will determine what is the best mortgage for you. Are you ready? Let's go. If this is your first time visiting the channel, and if you want to know everything there is about the Houston market and Houston's best real estate, then subscribe below and tap the bell. That way you'll be among the first to know about the Houston market and Houston's best real estate. And by the way, my name is Michael Hughes. I'm a Texas real estate broker and a Texas real estate attorney of more than 20 years. And along with my wife and business partner, Carol Hughes, we help folks just like you buy and sell Houston's best real estate. In today's real estate market, roughly 2/3 of all real estate transactions involve mortgage loan financing. So it's very important to understand what mortgages are, how they work, and the different types of mortgage loans that are available on the market. There are a lot of different mortgage loans and different mortgage loan programs out there. Some loans are insured or guaranteed by the government, while other loans are not involved with the government at all. Some loans have interest rates that are fixed, meaning they will never change, while other loans have adjustable rates, meaning they can and they will be adjusted at different times throughout the loan. Each buyer has their own unique set of circumstances that impact their ability to qualify for a mortgage loan. And there are a lot of different loan programs out there, each one tailored to different buyers with different circumstances and needs. Your individual circumstances, such as your financial goals, your credit history, your income, past or present military service, even the location where you're buying the home, all of these can affect what is the best mortgage for you. The mortgage world speaks its own language, and there are a lot of specific terms or acronyms that may sound odd or unfamiliar. So let's take a look at just a few of these and how they relate to a buyer's process of qualifying for a mortgage loan. First is the down payment. A down payment is an amount of cash that the buyer is going to pay for the home at the closing, so that the lender will give a loan for the rest of the purchase price. By making the buyer invest their own cash into the property, this assures the lender that, one, the buyer is serious about the purchase, but also, two, that the buyer is going to be serious about repaying the loan so that they don't lose all of the money that they already have invested in the house. Now, down payment requirements are going to vary between different loan programs and according to individual circumstances. But absolute minimum down payment requirements can range from 0% to 3%, 3.5%, 5%, or perhaps more in certain circumstances. PITI is a term, an acronym, that describes the buyer's total monthly mortgage payment. A buyer's total mortgage payment typically will consist of 4 different parts, the PITI. So that means principal, interest, taxes, and insurance. PITI. Principal, interest, taxes, insurance. All of these amounts combined make up the buyer's total mortgage payment. Let's give an example of this. Let's say that the amount of the principal and interest required to pay off the note in whatever time frame is $500. So the principal and interest combined is $500. Let's say that the monthly property tax amount is $300. That puts us up to $8. And the insurance amount on a monthly basis is $100. So our total PITI payment is going to be $500 plus $300 plus $100 gives us $900 that the buyer will see as their monthly mortgage payment. Now, the last term we're going to look at in this video is private mortgage insurance. And this has two different names. It's either called PMI, private mortgage insurance, or it's also called MIP, mortgage insurance premium. Different loan programs have different names for the same thing. Now, this is only required in certain circumstances and with certain loan programs. But wherever it's required, the PMI or MIP amount is an amount of money that the buyer is required to pay each month. And this amount of money covers the premium cost of an insurance policy that is in place in order to pay the lender in the event that the buyer defaults on their payments. So there's an insurance policy that exists to pay off the loan for the lender, and they make the buyer pay that premium. That is private mortgage insurance or mortgage insurance premium, depending on your loan program. So if we use the previous example of our PITI payment of $900, let's say, for example, just pulling numbers out of the air, that the private mortgage insurance premium is $30. That will be added on to the monthly payment. So now we have a total monthly payment for the buyer of $930. Well, thank you for sticking with me through that part. I think you're going to see how looking at that terminology is going to be helpful as we talk now about the different types of loan programs that are available on today's market. We're just going to take a look at the most common ones. First off are conventional loans. Now, the phrase conventional loan is sort of a catch-all, and it means any loan program or loan out there that is not backed by the government. If it's not backed by the government, we call it a conventional loan. And then we can have a bunch of subcategories about the type of conventional loan. But overall, it means a loan that is not backed by the government. Since they exist purely on the private market, conventional loans typically have more stringent qualification requirements than do government-backed loans. So for conventional loans, typically we're looking at higher income requirements, higher credit scores. For the down payment, the minimum down payment for a conventional loan is 5% of the purchase price. In some cases, it can go down to 3% of the purchase price. If the buyer is able to put down a cash down payment of 20% or more, then that buyer will not be required to pay private mortgage insurance on that loan. Next up are FHA loans. The Federal Housing Administration was created back in the 1930s, and it was actually the FHA that created the very first 30-year fixed-rate mortgage loan, and that remains their signature product today, the 30-year fixed-rate note. An FHA loan is issued by a private lender, but the loan is insured by the Federal Housing Administration. If the buyer defaults on the payments, then the lender has the right to go to the FHA and seek repayment of at least some of the loan amount. This functions to reduce the level of risk that the lender experiences in making that loan, and it permits the lender to offer loans to people who otherwise might not qualify if they were on the purely private mortgage loan market. FHA loans typically have easier qualification requirements and lower interest rates than conventional loans. But with an FHA loan, the buyer is required to pay the mortgage insurance premium, or the MIP, as an additional amount on every monthly mortgage payment for that FHA loan. VA loans are available to current and former members of the United States Armed Forces. A VA loan is issued by a private lender, but the loan is guaranteed by the Department of Veterans Affairs, which means that if the veteran borrower defaults on the loan payments, then the lender can seek at least a partial repayment from the federal government. Just as we discussed with FHA loans, this serves to reduce the level of risk that the lender experiences in making a VA loan. And it also makes qualification requirements a bit easier, and it has a dramatic impact on interest rates, which tend to be lower with VA loans. With the VA loan program, there is no requirement for a cash down payment, and there is no requirement for the buyer to pay any private mortgage insurance. What this means for veteran borrowers is that it is possible for a veteran to purchase a home with no down payment and only bring to closing the amount of the closing costs. Another way to categorize mortgage loans is on what happens with the interest rate. And here we're talking about fixed rate loans versus adjustable rate loans. For a fixed rate loan, the interest rate on the mortgage loan is set at the closing, and it doesn't change throughout the life of the loan. So, for example, if you close a loan at 6%, and that is a 30-year fixed rate loan, then you know that for 30 years, your interest rate is going to be 6%, and it will never change. If the prevailing market interest rate jumps up to 10%, you're still at 6. If the prevailing market interest rate falls to 3%, you're still locked in at 6. These types of loans are great because they provide stability. You're able to make plans. You're able to depend on the fact that for 30 years, your interest rate is going to be 6% and it's never going to change. Now, with fixed rate mortgages, one quick word of caution, and that has to do with that PITI payment we were talking about before. With a fixed rate note, as we just discussed, the principal and interest part of it will never change over the entire life of the loan. But that does not mean that the taxes and insurance part cannot change. They can, and they very often do. If the tax rate changes, then that can reflect a change in the tax portion of the escrow. If the insurance premiums suddenly go up, then that can impact the insurance portion of that PITI payment. So just because you have a fixed rate mortgage, that does not mean that your monthly payment can never change. It can, and it often does, based on changes in either the tax rate or the insurance premiums that are due. So be aware of that. On the other hand, we have adjustable rate mortgages. And as the name implies, with these loans, the interest rate can and will be adjusted at certain times and in accordance with certain terms that are recorded in the loan documents. These loans often feature an introductory period where the interest rate will remain constant, say for 5 years, maybe 7 years. But then after that, every year, the interest rate will be adjusted either up or down, depending on another interest rate that is referenced in the loan documents. One of the most common ones is called the SOFR, which is found at the Federal Reserve Bank of New York. just as an example. So if that rate goes up, then your interest rate on your mortgage is going to be adjusted upward by that same amount, and your payment is going to go up accordingly. Of course, the same could be true if the interest rate went down, but how often does that really happen? Now, adjustable rate mortgages can be great things for people who are just starting out, or maybe they're recovering from some bad financial event in their life, or they're in a circumstance where they expect that their earning level, their income level, will increase over time. And these can be great solutions for them. But you need to be careful with adjustable rate mortgages. You need to always bear in mind that the rate will adjust. In the past, we've seen a lot of news stories about people who have encountered unfortunate situations where they did not account or they did not factor in the potential rise in interest rates and therefore the rise in their mortgage payments, and they ran into trouble. So always bear in mind with an adjustable rate product that your interest rate is not fixed, that it can and will fluctuate every year based on whatever that underlying interest rate is. So, back to the original question, what is the best mortgage? It's going to be the mortgage that aligns with your values and works the best with your financial situation. Now, that can be any number of different loans or loan programs. So to answer the question, we will need to do a little bit more digging to get some information. Things like, what's your monthly budget, including income and debt payments? What's your credit profile, and are there any actions we can take to improve it? After all, higher is always better. How long do you plan to stay in the home? Is it a short-term home for you, or you plan to be there long-term? Do you have any current or former military service? Is the property located in a rural area or a USDA designated suburban area? What is your risk tolerance for changes to the mortgage interest rate? Answers to these and a lot of other questions are going to form the foundation of the strategy to find the best mortgage for you. Once you decide on the best mortgage, then the next step is for us to start down the path of qualifying you for that mortgage. Now, each loan program is different and each one will look at different things. But as a general rule, any loan program you apply to is going to be interested in things like your credit history, your debt to income ratio, that is, how much of your monthly income is taken up with debt payments, your employment history, your monthly income, any other assets that you might have, and the amount of the down payment you're planning to make for the property. You also will be required to provide a lot of documentation to the lender, both to establish your initial qualification for the loan, but also to verify all of the information that you provide to the lender. Common documentation requirements include things like tax returns, minimum of 2 years, and we're talking about the full tax return with all the schedules. Bank statements, minimum of 2 months worth of bank statements. Pay stubs, again, minimum of 2 months. If you're planning to use any sort of other income or irregular income as a basis for repayment of the loan, things like bonuses or commissions, things like that, then you'll need to provide proof of those items. You'll need to provide identification and social security documentation, and you'll also need to provide proof of your military service if you are pursuing a VA or a Texas Veterans Land Board loan. Now, if all of that seems overwhelming, Believe me, I understand. It is overwhelming. There are a lot of details and a lot of moving parts, all to keep going in the right direction. But that is where working with a professional, experienced real estate agent makes all the difference. In addition to that little thing of finding the perfect home for you, your agent also can connect you with a trusted local professional mortgage lender. We can help you understand your financing options and the documentation required for each one. We can walk through the process with you, making sure that we don't miss any requirements or deadlines. And we can negotiate strategically based on your financing terms. As your agents, Carol and I advocate for you at every step of the process, making sure that your mortgage aligns with your goals. Choosing the right mortgage is a critical step in your home buying journey, and it is one that will have long-lasting effects. But you don't have to make that choice alone. Working together, we can make sure that you understand the basics about mortgage lending, that you know your options among all of the choices that are out there, that you are connected with a local, trusted, professional mortgage lender, and that the process goes smoothly. If you are thinking of buying a home in Texas and you're ready to start the process of qualifying for a mortgage, or if you just have questions and you want to discuss options, then reach out to us or just leave a comment below. Carol and I are here to help. Now, whether you're thinking of starting your next home buying journey next week, next month, or even next year, Carol and I would love to help make your next home purchase smooth and worry-free. So click on the link below to set up a one-on-one Zoom consultation. Or, of course, you can always give us a call, shoot us a text, or send us an email. We would love to hear from you, and we are looking forward to helping you buy or sell Houston's best real estate.